Hey everyone. One of the things I frequently talk about is cap rates. Their movement over time, the spread between the average cap rate and the 10-year treasury, the average cap rates in different types of markets, and the average cap rates in different classes of properties. But in general, I mostly just use the average cap rates to track their motion, whether they're going up or down, and by how much. It's a benchmark. This can help investors stay in tune with the broader investment climate. But inevitably, someone looks at the average cap rate and thinks it's totally wrong. If I'm in a metro with a history of strong appreciation and where capital is aggressively pursuing assets, I often hear that the average cap rate is too high. If I'm in a metro with slower moving capital flows, the feedback may be that the average cap rate's too low. But the personal perspective of investors varies widely. The markets they're active in, the assets they're focused on, the things that are top of mind, they don't always reconcile with a blended average cap rate that incorporates all classes of properties from markets all across the country. So this week I'm going to drill a bit deeper. I'm going to break out specific subsegments. Now, the average apartment cap rate in the US is about 6%. But if you narrow the span to just primary markets, the average cap rate is 5.7%. And the average cap rate in tertiary markets is 6.6%. Meanwhile, the average cap rate for Class A properties is 5.8%, and the average for Class B and C combined is 6.1%. Then if you take it a step further, the average cap rate for a Class A properties in primary markets, the best of the best, may be as low as 4.7%. At the other end of the spectrum, a Class C apartment in a small tertiary market may have a cap rate around 7.2%, and perhaps even higher. These are still averages blending markets and deals, but they offer more granular insights. One of the things I've found most fascinating in recent years was the movement of cap rates in different types of metros. In 2019, capital began to more aggressively flow into secondary markets, driving the apartment cap rates in those metros lower. Then in 2020, tertiary market cap rates followed. Apartment cap rates in primary markets began to decline later in 2021. So there was a compression of the market risk premium between metros of different sizes as capital pursued the higher yields offered by smaller cities. Back in 2018, the spread was about double that. So my point here is that there are definitely nuances affecting different types of assets in different markets. So even though the average cap rate for apartments is 6%, the cap rate range is somewhere between 4.7% and 7.2%. And of course, there are outliers beyond that 250 basis point range. For office properties, the average cap rate is 7.9%, but we have a range from 6.1% to 9%, a 290 basis point spread. For multi-tenant retail, the average cap rate is 7.4%, with a range from 5.9% to 8.5%, a 260 basis point spread. The spread on industrial properties is even wider, 310 basis points, running from 5% to 8.1% with an average of 6.9%. That reflects the wide variance in industrial property vintages and quality and market demand levels. It's one thing to be proximate to the ports in LA, and it's a whole different world for a small, older infill warehouse that's far from major supply chain hubs. The average self-storage cap rate is 6.5%, ranging from 5% to 7.5%. And the property type with the widest range of cap rates is hotels, which could have a cap rate in the 6% range all the way up to the 11% range with an average of 8.6%. And again, if you think about it, a hotel could be a small independently operated asset in an out-of-the-way market, or it could be a property with a premium flag like Marriott or Hilton with an excellent location. So when I talk about average cap rates, think of it as a place to start. It's a useful piece of information for monitoring general trends, but it most certainly is not the end of the road. It's the start. Investors should be drilling much deeper than that, understanding the local market dynamics, the local flow of capital, and the other forces driving the local market. And within those nuances, investors can often find unique opportunities. So every week, I close by saying investors need to keep their eyes on the horizon. But this week, I also need to reiterate the value of drilling below the surface. Use a shovel, not a rake, when you're digging for insights.